When you start your investing journey, it's never about numbers. It's about dreams. Retiring early, buying that car you always wanted, pay for the school, owning a home. There are thousands of reasons, and each one feels personal. For me, it started with one goal, saving for the down payment for my first house. And that's why I opened my first home savings account, FHSA. Every stock I picked, every dollar I invested was a step towards that dream. I handpicked each stock in my portfolio, hoping they will pay off. And when they do, you take those profits and move closer to your goal that you started with. In my case, I'm not there yet. My target is $60,000 to $70,000 in that FHSA account, so I can pay for the down payment for my house. So I keep pushing and investing $1,000 every month into my FHSA. But here's the thing. I don't want to throw my capital into a stock that already climbed the mountain. I'm talking about Google. I'm thinking of trimming my winner and reallocating that capital into something that market isn't cheering for, at least for now. Trimming Alphabet, right in the middle of euphoria, and rotating those gain into MasterCard, a world-class business that somehow looks undervalued. In this video, I'll share why I'm not adding any more capital to Google and why I'm buying MasterCard instead. Let me be very clear. Google is a phenomenal company. If you held the stock in past year, chances are your position is nearly doubled. A massive success built on real fundamentals. The AI story with Gemini 3, it's compelling. The most sophisticated model yet. A technical leap over competitor is driving adoption in Google Cloud. The antitrust fear is all gone. That boosted investor confidence. The company is thriving. Riding that wave felt incredible. But then, that contrarian voice whispers, should I keep adding more money to Google? This is where emotion meets logic. I have to stop asking, do I love Google as a company? Because I do. And start asking, is Google, the stock, the best place for my money right now? This is purely portfolio management. I'm keeping my investment balanced. Because here's what happened. When a position doubles, that neat little 8% slice in your portfolio, it quietly swells into 16%. That's concentration risk. I'm not saying sell everything. I'm saying trim it back to something manageable. Back to like 8%. That's not fear, that's discipline. It's optimizing risk versus reward. And I'm being honest, the reward potential now, it's smaller than it was a year ago. Even just 8 months ago, Google was in panic mode price. 11 to 12 times forward earning. That was a gift. Today, it's around 20 times. Not insane for Google, but fully priced. Most of the good news is already baked in. If you look at the adjusted for one-time investment gains, Google trade close to 39x core earning. You see Google's profit, the one that they report to the public, gets this huge artificial boost from their investment in private companies like SpaceX, Anthropic. When those companies go up in value, Google profit looks even bigger than they actually are. So when you see the actual business of Google, like the cloud business, the search business, or the YouTube is doing, we have to strip out those investment and look at the core operations earning. When you do that, the picture changes big time. Google looks more expensive than Amazon and Microsoft. Just months ago, headlines screamed fear. ChatGPT will kill Google search, Google lost the AI race. That was the time to buy. Today, the narrative is completely opposite. Gemini 3 is a game changer, Buffett is buying, Google's TPU chips will challenge Nvidia. When the whole mood is euphoria, the contrarian mindset kicks in. Buy speculation and sell the news. Be loyal to your capital, not to the stock. So where do those Google profits go? For me, the new home is MasterCard. This is a big shift from search and ads to the bedrock of global commerce. And let me tell you, the business model of MasterCard, it's a thing of beauty, a capital light, quality compounder. It is a kind of business that doesn't need massive factories or sprawling data center to grow, which means high margin and loads of free cash flow. And here's the important thing to notice. MasterCard is not a bank. They don't lend. They don't take default risk. They are the network, the digital toll road, facilitating trillions of dollars in transactions worldwide, and taking a tiny slice of each of those transactions. That model is why stock is up something like 13,000% over the last 2 decades. A compounding machine that long-term investors love. The profitability is staggering. Out of every $100 in revenue, roughly $51 turn into free cash flow. That margin has climbed for a decade, hitting nearly 51% in 2024. The bigger they get, more profitable they become. Now, despite the stock being up 75% over 5 years, profit and cash flow has grown even faster. That means the business has outperformed its own stock. Results, the price to cash flow multiple has compressed. Right now, MasterCard trades near 28 times its cash flow, one of its cheapest level in 5 years. And for years, you paid a premium for MasterCard versus Visa. Today, MasterCard is cheaper and still the fastest grower. Analysts expect MasterCard to grow earnings about 16.4% over the next 3 years versus Visa at 12.5%, which has higher quality, faster growth, better price. That's textbook value investing. Recent revenue about 17% year over year. Even if the market cools and the PE multiple falls, let's say to 26, the underlying growth still points to roughly 9.5% annual return. That's comfortably above the long-term market average. That's a margin of safety I like with my investments. Now let's talk risk. No investment is complete without risk analysis. First, government rails. In markets like Brazil and India, governments are building low-cost payment systems that could bypass MasterCard for domestic transfers. The other thing, the major client loss. Capital One buying Discovery likely means Capital One cards migrate off MasterCard's network. Last, but MasterCard is tied to consumer spending. A deep global recession would dent travel and transaction, slowing revenue growth. Selling or trimming a huge winner like Google comes down to 3 points. Evaluation. Google's bargain is gone. On a core basis, it's expensive. MasterCard trades at a rare discount on cash flow right now. Google sits in a moment of extreme hype, a classic cue to take the chips off the table. Third one, opportunity. Be loyal to your capital. Right now, it likely works harder in a cash-gushing, high-quality business like MasterCard that's less crowded and projected to grow faster relative to its price. The question isn't Google is a good company. It is. The question is this the best place for my money right now? When a stock is overhyped and your position has become oversized, the answer is often no. That's your cue to move your profit to the next great opportunity.